All right, let's get straight to it. Lyft's stock is an absolute war zone right now. After their Q4 earnings dropped, the bulls are pounding the table, screaming that this is the comeback of the year. On the other side, you've got the bears crying foul, saying the accounting is a house of cards. The noise, frankly, is deafening. So here at Iron Financial, our mission is to cut through all of that. We're here to forge a verdict from the raw, hard data. We are going to break down piece by piece whether Lyft is actually building a fortress for your portfolio or if they're just papering over some deep, deep structural cracks. Let's get to work.
Okay, here's our plan of attack. We're going to tackle this thing in 5 distinct stages. First up, we're going to put the official comeback story that management is selling under the microscope. Then, we're going to get our hands dirty. We're drilling down into the engine room to see if the core numbers, the real guts of the company, are solid. After that, and this is the big one, we have to confront the massive accounting question that has everybody talking. From there, we'll zoom out and assess the battlefield, specifically the colossal shadow of their #1 competitor. And only then, only after all the evidence is on the table, will we forge the final Iron Financial verdict.
Right. Before we get into all the heavy lifting and the spreadsheets, let's just pause and look at the official story. Every company that's trying to pull off a turnaround, they have a narrative. They have a story they really want you to buy into. Management gets out there and paints this beautiful picture of a business that's been reborn, one that's roaring back to life. My job here, as always, is to ask the really tough question. Is this story built on a foundation of solid steel, or is it just a house of cards, waiting for the first strong gust of wind? Let's hear what they're telling the market.
And there you have it. That's straight from the CEO, David Risher. He's calling 2025 an incredible year in Lyft's comeback story. And notice, he doesn't just stop there. He's already looking forward, promising this transformational phase with autonomous vehicles, or AVs, coming soon. This right here, this is the bull case in a nutshell. The argument is that the turnaround isn't just happening, it's actually picking up speed, and it's headed straight for some high-tech future. I mean, it sounds fantastic, right? But you and I both know talk is cheap. Now we've got to see if the actual numbers, the cold hard facts, can back up that kind of bold confidence.
Exactly. That's what it's all about. So for a minute, let's just push the story, the narrative, the promises. Let's push it all to the side. It is time to put on our hard hats and go inspect the machinery, because the only way to know if a company is truly strong is to get down into the engine room. We need to look at the core operational metrics that actually power the business. These are the numbers that can't be spun. They don't lie. They tell us if the company is generating real activity, real momentum. So let's silence the chatter and let the data do the talking. What is the engine room really telling us?
So the very first number we have to look at, the one that everything else is built on, is gross bookings. For the fourth quarter, Lyft processed a massive $5.1 billion worth of transactions. Now, let's be crystal clear about what this is. This is not their revenue, and it's definitely not their profit. Think of it more like the raw horsepower of the platform. It's the total dollar value of every single ride, every tip, every fee, every toll that flows through their system. It's the absolute top of the funnel, and it is the single best indicator of the health and scale of their entire ecosystem. A bigger number here simply means the machine is processing more fuel, plain and simple.
Okay, now here is where that comeback story starts to feel real. That $5.1 billion figure, well, that's a 19% increase compared to the same quarter last year. Let me repeat that, 19%. That is not trivial growth. In this economic climate, seeing a nearly 20% jump in your most critical top-line activity metric, well, that's a seriously powerful signal. This isn't a business that's just treading water or stagnating. No, this is a business that is actively and aggressively expanding its footprint. It's convincing more people to spend more money on its platform. From a structural standpoint, this is a very sound indicator of a healthy, growing operation.
So, the next logical question is, where did that bookings growth come from? Well, it comes from this number right here, 29.2 million. That is the number of people, the active riders, who use the platform in the fourth quarter. If gross bookings is the horsepower of the engine, then active riders, well, they're the fuel. You cannot grow one without the other. It's impossible. This metric tells us if the user base itself is actually expanding. Are they bringing in new customers? Are they winning back old ones who left? For any platform business, this is one of their most critical vital signs you can look at.
And the story here is one of pure, unadulterated momentum. Just like we saw with bookings, rider growth isn't just strong, it's actually accelerating. We're looking at an 18% increase year over year. Think about that. They added nearly 5 million active riders in just 12 months. This is crucial because it shows that the growth in their bookings isn't just coming from jacking up prices or squeezing more money out of their existing users. No, they are actively growing their customer base. They're taking back ground.
This is tangible, hard evidence that their renewed focus on the customer experience is actually paying off and bringing more and more people onto the platform.
And here, right here, is the payoff. All of that operational strength, more riders, more bookings, an all-time high in the number of rides given, it all translates directly into financial power. Look at this. Adjusted EBITDA, which is a key measure of profitability that strips out some accounting noise, was up a massive 37% to over $154 million. But the real headline, the number that should make every investor sit up and take notice, is the free cash flow for the full year, $1.12 billion. That is a mountain of cold, hard cash. This is the money that's left over after you paid all the bills to run the business. This is what you can use to pay down debt, to buy back stock, to invest in the future. This isn't accounting magic. This is real cash hitting the bank account. This is the foundation of the bull case. Real operational growth leading to real cash generation. The engine is absolutely firing.
Whoa, hold on a second. Firing on all cylinders? I mean, that free cash flow number is impressive. I will absolutely give you that. But a powerful engine isn't worth much if the chassis it's sitting on is cracked. You've just shown us the shiny exterior, all that great growth in bookings and riders. But the moment you start digging into the fine print, looking at the real bottom line gap numbers, some pretty serious questions start to pop up. See, top line growth is one thing, but how that growth actually translates to the bottom line, well, that's what separates a strong, durable investment from a speculative trap. It's time we find out if this whole structure is fundamentally flawed.
So I have to ask the most direct, simple question possible here. We just saw 19% growth in gross bookings. We saw 18% growth in active riders. That is a huge amount of new activity on the platform. So the logical conclusion, right, would be that revenue, the actual money that Lyft gets to keep in its pocket, should have also seen a pretty spectacular increase. But did it? Did all of that heavy lifting on the operational side, all that growth, actually translate into a win on the income statement?
And the answer to that question is a big, resounding no. And this, right here, is the first major crack in the armor of the bull case. The reported $1.59 billion in revenue for the quarter, but Wall Street, the consensus, was expecting $1.75 billion. Now that's not a small miss. That is a significant $160 million gap. So how is that even possible? How can your platform activity be surging by nearly 20%, but your actual revenue comes in so far below what everyone was expecting? It suggests one of two things. Either they had to slash prices to get all those riders in the door, or their take rate, the percentage of each fare they actually get to keep, is under some serious pressure. Whatever the cause, this disconnect is a major, major red flag.
Okay, now for the main event. This is the headline that sent the stock soaring initially, a record quarterly profit of $2.8 billion. I mean, on the surface, it looks absolutely incredible. It seems to validate the entire comeback story in one fell swoop. But when we deconstruct that number, when we actually look under the hood, the entire narrative just completely falls apart. The record profit wasn't a record at all, not in an operational sense. As this table clearly shows, the profit was almost entirely manufactured by a single non-operational line item, a $2.9 billion benefit from something with the very boring name of a deferred tax asset valuation allowance.
So what on earth is that? I know it sounds complicated, but let's just break it down. For years and years, Lyft lost money. A lot of money. The tax code allows a company to use those past losses to offset future profits, which lowers your future tax bill. This is called a deferred tax asset. You can think of it like an IOU from the government, a coupon you can cash in later. But, and this is the important part, accounting rules say you can only count that IOU as a real asset if you're truly confident you're going to be profitable enough in the future to actually use it. So what did Lyft do? They simply changed their accounting assumption. An accountant basically flipped a switch and said, hey, we now believe we'll be profitable, so we're going to put that $2.9 billion IOU on the books as profit today. This isn't cash. It's not from giving more rides. This is not forging a profit. This is papering over the cracks with a tax coupon.
Okay, that's a fair and absolutely critical point. The GAAP profit number is, without a doubt, misleading, and any investor looking at this company needs to understand exactly where it came from. It's an accounting benefit, not an operational one, period. However, even if we strip that out and we focus on the real, tangible cash flow we talked about earlier, there's a much larger, more permanent structural challenge that we have to confront. The reality is, Lyft doesn't operate in a bubble. It operates on a battlefield that is completely dominated by an absolute titan. And that context, that reality, changes everything about this investment case.
And this chart shows you the brutal reality of that battlefield. In the United States rideshare market, for every $4 spent, 3 of those dollars go directly to Uber. Lyft is left fighting for the scraps, for the remainder. A 24% market share means you are permanently the number 2 player in a 2-horse race. This isn't a competition between equals. This is David versus Goliath, and in this story, Goliath has a massive, maybe insurmountable head start. It doesn't matter how well Lyft executes, it doesn't matter how much they innovate or how much their customers love them, they are always operating in the shadow of a competitor with dominant, crushing scale.
Let me just hammer this point home, because the difference in scale here is almost hard to wrap your head around. We were just celebrating Lyft's $4.8 billion in gross bookings for the quarter. That's a great number for them. But in the exact same period, Uber did nearly $50 billion. That is 10 times bigger. 10! Uber's revenue was over $13 billion compared to Lyft's $1.7 billion. But the most critical difference, the real killer, is at the bottom of this table: diversification. See, Uber isn't just a rideshare company anymore. It's a global logistics platform. They have mobility, delivery, and freight. If the US rideshare market hits a soft patch, where does Lyft go? They have nowhere to hide. Uber, on the other hand, can just lean on its massive food delivery business or its growing freight network. This makes Lyft's position not just smaller, but structurally incredibly precarious.
Okay, we've laid out all the evidence. On one side of the scale, we have a clear, data-driven case for a very real operational turnaround. On the other side, we have extremely serious questions about the quality of the company's reported profit and, more importantly, its permanently disadvantaged position in the market. The bull case has legs. The bear case has teeth. Both are built on solid foundations. So, it's time to step back, weigh all of this evidence, and forge the final iron financial verdict. Is this an opportunity for your portfolio, or is it a trap? So let's be absolutely clear on this. The thesis for buying Lyft, the bull case, it's built on solid ground. The operational turnaround is not some fantasy, it is real. That 19% growth in gross bookings and 18% growth in riders are tangible, hard metrics that prove the core business is healthy and it's expanding. But even more importantly, the business has become a cash machine, generating over $1 billion in free cash flow this past year. This tells us, without a doubt, that management's disciplined, heads-down focus on execution is working. The engine room is strong, and it's getting stronger.
But the antithesis, the argument against buying this stock, is just as compelling, if not more so. That structure is still incredibly fragile. The headline record profit that got everyone so excited, it was an accounting gimmick. It's that simple. It completely masks the fact that actual revenue missed expectations, which points to a potential weakness in their pricing power. And you simply cannot ignore the 800-pound gorilla in the room. No matter what Lyft does, they're a distant number 2 in a market completely dominated by a much larger, more diversified, and better capitalized competitor. That isn't a temporary problem. That is a permanent structural disadvantage that is never going away.
So, here is our final verdict. Both arguments are valid. The turnaround is real, but the structure is undeniably fragile. Therefore, our conclusion here at Iron Financial is that Lyft is a company under construction, not a completed fortress. The foundation, and by that I mean the operational metrics and the cash flow, is absolutely getting stronger. Management is doing the heavy lifting day in and day out, and it is showing real results. However, the walls are not yet fortified. The company remains exposed to the brutal weather of intense competition and any potential economic headwinds that might blow its way. So an investment here is a calculated risk. It's a bet on that construction project being completed, not a safe investment in an established stronghold.
And that, of course, leaves the final and most important question for you, the investor. We've shown you the strength of the new foundation they're pouring. We've talked about the impressive cash flow and the solid rider growth. We've also shown you the cracks in the facade, the misleading profit, and that giant competitor that's always looming next door. So now you have to decide for yourself. Is Lyft's new foundation strong enough to build a position in your portfolio, or are the structural risks, the permanent disadvantages, just too great to bear?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.